Everybody, you know me. I'm Kellen. I'm from Dvele, and I'm the director of growth. I'm helping you learn more about Dvele. When we thought we'd start doing more of these office hour video sessions every week, or try to do them every week, just so that we can help you out and give you lots of information about, how you think about buying a modular home, preparing your land. And in this week, we're actually really lucky and really excited. We actually have Jeff Crowley on the video with us. Hi, Jeff.
Hey, how you doing, Colin?
Great, great, thanks. So Jeff is really an excellent partner of ours. He's one of our preferred lending partners. He works with a company called Federal Savings Bank, and we'll get into more of that in a little bit. But I really, really wanted to bring him on here because so many people ask us questions about financing, how it's different with a system-built home, which is technically a modular home, what we do off-site building, which you're going to get into and define a little bit more. So we really wanted to make sure you had questions answered about the system built construction financing, what that looks like, how do you prepare for it, are there different payout schedules, all that sort of stuff. So we just started recording. We're just going live now. We're going to let a few people jump in and get notified about the video stream. So we're just going to wait for a couple of minutes. So if anyone has any questions, just feel free to put it in the chat. You should have it on the right side of your screen. We'll try to hold questions until the end of Jeff's presentation, just so that we don't get too off track. But if there are general questions that you want answered during the presentation, we'll try to take those. Any specific questions you have about your project or financing, let's try to hold those until the end. And then we'll even show you how to get in touch with Jeff. We have a landing page from Dvele and the Federal Savings Bank, and it'll put you directly in contact with Jeff, and it can help you start that process and help you answer any questions you might have. Um, Hello, Tony. Yes, today we have Jeff. You should be able to see Jeff on the video as well. Jeff is one of our preferred lending partners from the Federal Savings Bank. So we're going to be talking about financing a modular home, or more specifically, financing a system-built home, which is what we do. We're going to get started in just a moment. I'm just letting people know in the chat as well. How's your day going, Jeff?
It's going well. I am in Colorado, and the weather here has turned nice. It's sunny. It's going to be warm today, so it's a wonderful day to be in Colorado.
Maybe I should think about visiting Colorado. We just got hit with a huge storm, and it's supposed to last for another day.
Oh, no.
Yeah, a nice big snowstorm. Yeah.
There's some Steamboat, Colorado has had 17 feet of snow already this year.
Really?
So anybody out there is a ski fanatic, come to Colorado, go to Steamboat. The skiing, I guess, is absolutely amazing up there.
Wow. I would love that. I would love some like majestic kind of Disney-like snow. Up here in Canada, we just get like heavy snow. It turns to ice. It melts.
Yeah.
Turns to concrete. It's not that great. You have to be up in the mountains. It's usually the best one.
That's right. Where in Canada are you, Kellen?
I'm East Coast, so I'm above Toronto. Toronto's the big famous city in the East Coast of Canada. So we're in the capital city of Ottawa here.
Got it.
We're in a valley, so the weather's always hit and miss.
Gotcha.
Yeah. Welcome, everybody. If you're just joining, I'm Kellen, the Director of Growth at Dvele, and today we have Jeff Crowley. He's from the Federal Savings Bank. He's one of our preferred lenders, and he just knows a lot about financing, the whole process, fun different ways to help you get finance for your homes, and just an overall good problem solver when it comes to these types of things. You'll really want to stay tuned and watch this or catch the recording later, because financing a modular home, which is called a system-built home or an off-site building home, is a lot different from the traditional type of building, which is your stick framing built on site. So the way banks view the asset and the process is a little different. So we want to make sure you know about that and know some obstacles to avoid and how to get over them. So in just a moment, we're going to jump into that with Jeff, and he's going to take us through a beautiful presentation about things to do, things not to do, and that whole process in general. So I think we should get started. We already have about 9 or 10 people in here. Some more people are joining as we speak, and then a bunch more people will be viewing the recording after. So, thanks again, Jeff. Really appreciate your time and being here. I know as a veteran, being in the industry for 27 years, you've seen a lot, helped a lot of people. And you specifically, everyone who's watching, Jeff has helped finance over 100 different system built projects or modular home projects. We'll use that term a bit interchangeably, but we'll describe it a bit later. So he's really, really helped the industry understand how these types of financing projects work. And he actually led the team when he was working at Fannie Mae and Freddie Mac to help understand these types of construction projects because they're not like a traditional home. So Jeff, just take it away. I'm going to be answering some people in chat whenever they answer a question, and I might just jump in and speak up if someone has a really important question we need to hear about. But otherwise, take it away.
All right. Thanks, Kellen. And I want to thank you for giving me the opportunity to join you today with Dvele. We really appreciate Dvele and what they do. Been to the factory, met all of the people who are the principals of the company, and we feel very, very good about doing business with them. And somebody's trying to get a hold of me on a.
That's all right. That's always happens.
Always happens. So first of all, let me tell you a little bit about me and my bank, and then we'll go talk about construction financing and how that works. So I have actually been doing system built or modular financing for 27 years, almost 28. This has been a niche of mine for a long time in this industry. I started originally when financing modular homes was not a thing. As a matter of fact, as you mentioned, Fannie Mae and Freddie Mac didn't even allow loans on modular homes back when I first got into this industry. And so there were a group of us that were involved in financing modular construction, system built construction. And what we did is we formed a task force and we presented information to Fannie Mae and Freddie Mac to get them to allow this as a product that they would back up in the secondary market so that you could get a mortgage on it once you had a construction loan to build your house. So I was a part of that way back when. I always said I did modular construction financing when it wasn't cool. So that started a long time ago. The bank I work with now is the Federal Savings Bank. We're headquartered out of Chicago, Illinois. We do business in all 50 states, and we are one of the industry leaders in the modular process. As you said, Kellen, I personally did over 100 modular projects last year, just in 1 year. I've done over 1,000 in my career. So it's something that we do. It's our niche. It's kind of what we do. And we think we're fairly good at it. So construction financing is different than a regular loan. A lot of people are familiar with how to go to a lending company or mortgage company or a bank and get a mortgage for a home. You can't get a mortgage loan on a home that's not completed yet. So you have to have some construction financing. You have to have the ability to finance the land if you need to pay the modular or system built construction company for the units that you're going to use for your home, and then to pay a general contractor for services like putting in the site work and utilities and whatever else has to be done to tie the whole project together. And I'm sure you've probably addressed that on other sessions on how to put together a project, a modular project. It is truly a system, and we like that with our bank. The typical construction loan lasts for 12 to 18 months, depending on the size and the dollar amount of the project. We can extend that for an additional 6 months if necessary. So we've had some projects that we've financed where it took a couple of years to get the project completed, but we can take up to that long of a period of time to get your project completed. A construction loan is different than a mortgage loan. Construction loan is a loan that we give you like a line of credit. Think of it as a giant credit card with a balance on it. We give you X number of dollars to do any of those things that we need to do, whether it might be the land, it might be the paying for the modulars or the general contractor, but we give you a line of credit to use as you need it to pay for those items. So it's a type of program that has progress payments where money is drawn at certain periods of time. And that's one of the idiosyncrasies of construction financing that's really important. It's a little different than a typical stick-built home. And some lenders aren't familiar with the way it works with modular or system-built financing. And that's where they get tripped up and they have difficulty sometimes doing a construction loan on a system-built home. The proceeds of this loan are not paid out in one lump sum. And the best part about it is you only pay interest on the loan as you use the money. So if you had $1 million loan that you're going to use to build a home, you're not paying interest on $1 million right out of the gate. Let's say your first draw is $100,000 for whatever, deposits on your construction. Something that has to get started with could be the deposit on getting the modulars built. It could be purchasing the land. Whatever that first step is, that can be a draw at the closing of the loan. That next month, you're going to be billed on whatever that outstanding balance is. And that's, you're going to pay interest on that amount only. So it's not a loan where you're going to pay interest from the start on the entire amount. The construction loan can be used to acquire the land if you need to. Some people have land already purchased and they have that they can use in the project. Some people want to include that with the construction loan. We can make that part of the deal. I get that question a lot. Can we use the construction loan to purchase the land? Absolutely, we can do that. Of course, the numbers have to work out. There's different types of programs which have different amounts that are required as down payment or equity. So any funds that you use in advance of the loan are considered down payment or cash in the deal amounts for equity purposes. So for example, if you owned your land, maybe you have it 50% financed and you put 50% in cash. That 50% that you put in cash, we're going to consider that equity or down payment in the transaction. Sometimes people do some of the items that are necessary to build their home. For example, they might have an architect draw up plans, an architect draw up plans, an engineer do engineering. You might do site work on your property. You might put utilities to your property. Any of that stuff that's done in advance, as long as we can document it, that can be used as equity in the project. Land that's already owned or land that's been gifted to someone can be considered as owner's equity, and it's given its current market value towards the total cost of the project. So we get situations all the time where somebody said, I have a piece of land I bought 5 years ago. If you've owned the land and been on title for more than 6 months, we're going to use the current value of that property as equity in the project. So if somebody bought land 5 years ago, and let's say they bought it for X and now it's worth Y, we're going to give them credit for that Y. If there's money that's still owed on the property, that can be a part of what we fund from the proceeds of the land. Depends again on how the numbers all shake out in the end. Any cash down payment that used for any type of part of the loan, facilities, utilities, planning, any of that stuff can all be considered as down payment as well. Sometimes we get people who get cash funds from a family member, parent, someone like that. We can consider that as down payment as well. All right. So there's really two ways to move forward on construction financing. The first phase, the first step is pre-qualification. All we're going to do here is see if someone qualifies for a certain dollar amount of money. It's a quick process. What it does is allows you, your banker, and the company that you're working with, in this case, if it's a Dvele home, we want to let Dvele know that you have the ability to borrow a certain amount of money to build your home. It typically starts with a very simple online application. It's a pretty easy application to follow. It can be done 24 hours a day. I've had people fill out loan applications for construction loans at 3 o'clock in the morning. So if you're a night owl, you can do that. We start out with a soft pull of credit. We don't want to affect your credit rating by taking a look at your ability to get a construction loan. So we do a soft pull. It tells us kind of what your credit score looks like, how many other debts and obligations you have during the month. And that's the way that we can use to determine what your qualification looks like. There are two other documents that we have to do a pre-qualification. We have to have an identification, an ID, can be a driver's license, copy of a passport, some kind of qualified identification. And then we also need documents that will help, allow us to calculate correctly your amount of your income. Those might be pay stubs, W-2s, sometimes tax returns if somebody's self-employed, but those are the items that we need up front to do a pre-qualification. The rest of the stuff is going to come later, but we can do it with those few documents. We can find out if you're qualified for a certain dollar amount. So soft pull of credit, an application, and a few documents, and we can pre-qualify you for your financing. Once we have determined the dollar amount of funding that you could obtain, we're going to have a follow-up conversation with you and talk about that amount to see if it's affordable for you. We're going to work on your loan amount. If you feel the dollar amount needs to be higher, there's some things we can do. We're very creative in what we do with the Federal Savings Bank. Any costs that would exceed the amount that we have a person qualified for, of course, is going to be money that has to be put into the project at the close of the construction loan. So cash to close comes at the time of the closing of the construction loan. Some people ask, can I put money in the project as I'm going along and building it? And the answer is no. Regulations require us, when we close a construction loan, we have to make sure that between the amount of money that we are lending the borrower and the amount of money that they have in the transaction, whether that's cash or equity, that those two amounts are going to cover all the costs of building the home. We have to make sure of that in advance. The pre-qualification process can happen quickly. Typically, it takes us about 24 to 48 hours to get someone pre-qualified. Again, to back up, we have someone fill out an online application. We take a look at that. We do a soft pull of credit, go through the numbers we figure out, calculate income, and then we contact that person and we have an over the phone discussion about their application and what that looks like. Once the borrower, once you're comfortable with that dollar amount, if we think it's going to work, then we can start working on the process to do a full approval of a construction loan. And that process is about a 5-step process. The first thing that we do need to do when we're doing a construction loan is we have to get the builder accepted, approved into our system. And that's a short process. It's not too complicated. We just have to make sure that whoever you're using as a builder or whoever is providing the modular or the system built home, that they are vetted and through our process and that they're qualified. We are going to advance money on your behalf to these people. So there's a vetting process. We have to make sure that we have some references from that individual. We have to have proper and acceptable licensing and insurance documents, because again, we're going to advance money to those individuals and we want to make sure that they're on the up and up. Want to make note that Dvele is fully accepted into our system currently, so they are good to go. If you're buying a home from Dvele, we are ready to go with them. The only other person that we'd have to get accepted and vetted would be the general contractor who's going to be doing the site work on the project. Okay.
And Jeff, just to quickly jump in, I think this might be true like it is for us with the general contractor. Once you've vetted the general contractor and you've even worked with them on a project before, do they stay vetted or do you continually go through that process?
Good question. Very good question, Kellen. Yes, once we have someone vetted, they stay in our system for at least a year. We can update their vetting after that. But yes, if we have a general contractor that we've done a project with before, they're already vetted, and we don't have to go through that process again, which happens a lot, actually.
Got it.
Right?
Thank you.
Okay, so the next set of documents that we're going to need are the construction loan documents. They're the construction bids, and that's what's going to drive this whole construction loan process. We would need things like a proposed contract from the provider of the home. In this case, Dvele would provide to you a proposed contract to purchase the home. That would take care of the system built home product. Then the general contractor would have to get third-party bids from the general contractor for all the site work, the floor plans, the elevations. It's essentially what we call our construction pack or bank pack of documents. We have to pull that all together because that's going to spell out what you're building, where you're building it, what it's going to look like, what it's going to cost, and a line-by-line budget that tells us how much it's going to take to get you from start to finish. I put in here, it's important to know that in order to move quickly on a construction loan, this part of the process has to be thorough and accurate. We can't just have somebody write on a napkin what they think it's going to cost them to build their home. Regulators won't let us do that. It'd be great if we could get away with it, but they're not going to allow that. So we have to make sure that we've documented the cost of building the home. Right? Then once we have all that information, we're going to build a budget. Just like any construction project, any business project, you have to have a budget. You have to outline what that budget looks like, when the money is going to have to be advanced, and on a line-by-line basis, what that's going to look like. So we take all those third-party estimates or that contract from that general contractor, the contract from Dvele, if they're the home provider, we take and pull that together, and we take those numbers. Those are called hard costs. Those are the numbers that we're absolutely certain are going to have to happen. Those are the numbers that are in your contract to build your home. Then we also do an estimate of what are called soft costs. Soft costs are going to be things like the closing cost on the construction loan. We put a contingency in every budget. That's that what if money. What happens if one of the line items or one of the bids is low and the actual cost comes in higher? We build a contingency into your construction budget in case that would happen. It's typically about 5% of the project, and it's there to cover those things that may not have come in exactly at bid, or something that might have come up during the construction project. In Colorado, for example, we get a lot of people who build in the mountains. And when they start excavating, they might find a big giant rock under the soil, and it has to be blasted with some dynamite or something. That's a cost, a contingency cost that we have a lot when building in Colorado. That type of thing. And we take all of that and put it all together, and that gives us a total overall budget. That budget is going to detail how much, if any, additional cash or money that the borrower has to put into the project. I wanted to mention that the contingency amount that we put in a budget, if you don't use it, if it's money that is never utilized, there's never any interest paid on that amount. Again, back when we started, we talked about you only pay interest on the amount of money that you use. So if we add another $25,000, $50,000, $100,000 to the approved budget, if you don't use it, you don't have any interest cost on that money. It's only if you have to utilize it for a cost over money. Then once we have all of this information, all of the specifications and the plans, what the house is going to look like, we get elevations, which kind of show what the house is going to look like on the outside. Dvele has an amazing set of plans that they provide in their homes. So we take that and then we send it out and we get what's called a specs and plans appraisal. That's where we give all this information to a local appraiser in your area. And we say, okay, if you built this house on this piece of property with these specifications, how much is that house worth in the current market? That appraiser is going to come back to us and say, this home is going to be worth X. That value is what we're going to use to determine how much money you may have to put into the project, what the loan to cost is. It's going to determine how much equity you're going to have in your land and other parts of your house. Sometimes homes come in where the value of the house is worth more than what you're paying to build it. That's always a good thing. We like it when that happens. So all that's taken into consideration because we have to meet certain guidelines in terms of how much money we can lend versus the cost or value of the house. Appraisals typically average around the country is about a 2-week process. There's some places that take much longer than that. There's some places that happens very quickly. But the general rule of thumb is it takes about 2 weeks to get an appraisal once we get that order out. So you got to wait a couple of weeks for that appraisal to come back in. Once we get that appraisal, we're going to have it reviewed. We have an appraisal desk at our company. These are people who have background and experience in the appraising industry. They know what to look for in an appraisal to make sure that that's good and it's going to stand up to the test for the regulations that we have to meet. They're going to look it over, make sure that you got a good appraisal on your home. If there's a deficiency in the appraisal, we're going to go back to the appraiser and ask them to correct it. If we think they've undervalued your house, we're going to say that. We're going to say, look, we might have comps that show that the house is worth more money than what the appraisal says. And so we have that kind of stopgap between the appraisal and our underwriters to make sure that the appraisal is accurate and it's going to reflect your property in a good manner. So we want to make sure we've got a good appraisal on the property. And finally, number 5, the last documents we have to pull together is we have to get a title insurance policy to make sure that the title is clear and clean on the property, that you have the legal right to transfer the property, that you have the legal right to take a loan out on the property. If there are any liens or encumbrances on the property, we're going to have to pay that off with the construction loan. That will roll that into that loan as part of, it's going to be one of those draws, one of those first advances on the loan. We also have to make sure that you have a homeowner's insurance policy that's going to cover all the risks that can happen during the course of construction. It's different than a typical homeowner's policy. There are some risks that it will cover that a typical homeowner's policy will not. So you'll have to get a hold of your local insurance agent. We'll coach you. You put them in touch with us. We'll let them know what kind of coverage you're going to need and in what amounts. And we'll pull those documents together. Once we have all of that, plus we'll update documents on you in terms of credit documents, things like make sure your credit's current, pay stubs are current, bank statements and assets are current. We're going to take all of that information now and we're going to send it off to our underwriting department for final approval. And our underwriting department right now is taking about 1 to 2 days to underwrite a file. That's a good turn time. So we get them turned around pretty fast, and then we get a clear to close. Once we have a clear to close, it typically takes about another 3 to 5 business days to put all the documents together, get it set up with a local title company or attorney, if you're in an attorney state, to set up your construction closing. That's kind of that whole full approval process. That's how that happens. Let's talk a little bit about draws and how the construction loan is funded. Once your loan is approved, we actually have I have a person here in my office in Colorado that handles all the draws on all my construction loans that I have in process right now. Right now, Sandy is handling about 125 construction projects. She does the draws on those, and she does a fantastic job. She usually turns those draws around in about 24 to 48 hours. Draw works kind of like this. We're not going to advance money on your construction loan without your knowledge and your approval. So you as a borrower are going to complete something called a draw request form. It's a simple form. We're going to teach you how to use it when we close your construction loan. You're going to take that draw form. Essentially what it is, it's the document that asks for a draw on your construction loan. You're going to take that document, a copy of the invoice from either the home builder, your general contractor, whatever it is that the item that you have to pay for. We're going to get an invoice, and then we're also going to get something called a lien waiver. Lien waivers are really important in the construction lending business. A lien waiver is an agreement, a sign off by whoever's getting paid. They are acknowledging that they have receipt of this money once we pay them, and that they can't come back and try to charge for those services again. It keeps them from putting a mechanic's lien on your property to try and get more money for their goods or services later. Essentially what they're doing is they're releasing any liability to you and to us as the bank for that payment on that portion of your draw process. So you're going to take those documents and you're going to submit them electronically to Sandy in my office. She's going to reconcile that against the budget, and then she's going to send out an electronic payment to either the dealer or the general contractor. We don't do checks anymore. Very, very rarely. Once in a while, we'll send a check out, but pretty much everything is done electronically now. It's all done by money wire straight into your dealer or general contractor's bank account. It's fast, it's simple, it's efficient, it can be tracked well, and it's very secure, very secure. Each of those draws is measured against that line item budget. What's nice about this is as you're building your home, if you go out of budget on a certain line item, we know it right away. Then we'll have a conversation about, are we going to tap into that contingency money if we have a cost overrun? Can we take it and apply it there? And typically that's the way it's handled. Sometimes on a line item is paid for, the work's completely done, and the bid was over the amount of money that we used. If that's the case, then you're going to have a credit that you can add to your contingency, that little pool of money that can be used for items that did not fall in budget exactly. And it gives you some extra money that you can use on a different line item. We can't do that until that line item is complete. So for example, let's say you're putting in the foundation. We have a bid dollar amount of X. That foundation gets put in and that work is completed. If the amount of money that we allowed in the line item is more than it costs to do the foundation, once that's completed and we know there's not going to be any more money that we have to advance against the foundation, if there's excess money in that budget, we can move it over to another line item that can be used later in the process. You can't do it in advance. You can't say, for example, we've had people say this, well, the last thing I'm going to do is put up my garage on my house, but I think that's going to cost less than my budget. Can I pull some money out of my garage budget and put it towards my foundation? And the answer is you can't do that. There's regulations about that. So I always try to explain that to people so they have some kind of an idea on how all this draw money is going to work. Best part about it is we've done this 1,000 times. We know what we're doing. We're going to walk you through the process as it goes. If we see something that's coming up that we need to have a conversation about, we're going to get on the phone or get on an email or both, and we're going to make sure that we go over it and make sure that everybody's comfortable with it before we advance any money. Okay. Let's see. All right. Let's talk about some do's and don'ts. We forget to do this a lot in our industry, and we need to do it more often. There's some certain things that you should do if you're doing a construction loan, and there's some things you shouldn't do. And I'm just going to cover a few of them. I'm not going to go through all of them. But one thing you want to do if you're doing a construction loan is you want to keep your job. You want to make sure you have the same employment. Just because we approve somebody for a construction loan, remember, at some point, we're going to convert that construction loan to a mortgage, and you're going to need employment to qualify for the loan. So we tell people, don't change jobs when you're in the middle of a construction project. It can be problematic. Notify us immediately if your compensation changes. Make sure you pay attention to any correspondence from us. Keep everything documented. If you pay some money out of pocket on a particular cost, make sure you keep a receipt and show how that money was paid out. Make sure that you keep all your payments on time with other credit items such as auto payments. credit cards. It can kill your credit score if you make a payment late on a credit card. Excuse me. We just had a situation like that where a guy was going along fine, multi-million-dollar project, and he forgot to pay a credit card, and he had a late payment on it, and it dropped his credit score 30 some points. It was terrible. So make sure you watch out for that kind of stuff. And most importantly, call us anytime if you have any questions or concerns during the construction process. We're glad to talk to people. We take a lot of calls every day, and we want to make sure we have good communication with our borrowers. Some don'ts. Don't quit or change your job. We kind of talked about that. Don't apply for any new credit. Sometimes I get people who are building a house, go, oh my gosh, I'm building this nice, beautiful home. I need new furniture for my house, or I need a new hot tub, or I need whatever. And so they go out and they buy it and they put it on credit, and that adds an additional liability, and that can mess up our debt to income ratios when it's time to convert it into the mortgage.
So Jeff, just one
yes.
second. If I want new furniture for the house because it's a new home and it's going to be like $10,000 for beds and couches and stuff, is that something that we could do through you as well, through borrowing?
Yeah, we have a separate loan. We have a consumer loan. It's not a secured loan with the property. We can do that. And what I'm really trying to say to people is, if you want to do something like that, just make sure you communicate it to us so we can go in and check and see how that's going to affect your numbers. Yes, we have an unsecured loan now. I believe we can go up to $50,000 with a separate loan that is not a part of your construction loan. It's a very good question, and thank you for asking, Kellen, because I probably would have forgotten to talk about that. So, yeah, it's a good way to do it, because then we're aware, we know about it, we can do the calculation, we can say, hey, if you need $20,000 for furniture and a hot tub, we can give you a loan for that. We can do that. Watch moving large amounts of money in and out of your bank accounts. Sometimes things just happen, and we're just saying that because it can have an impact on underwriting your loan for the final mortgage. Try not to write any insufficient fund checks or co-sign for anybody else on a loan. That's some other ones, and they're on here. And we are recording this, right, Kellen?
Yes, we are.
So if you have any questions about that, you can always pull up the recording and take a look at those do's and don't lists. There's probably a couple, but I think I got most of them on there for you. Okay. Finally, once the house is completed and you receive a certificate of occupancy, most jurisdictions will issue that to you. Once your home has been inspected and meets certain criteria, the county, typically where you're building in, will give you something called a certificate of occupancy. That allows you to move into your home so you can occupy it. It's saying that there's enough construction done to move in and live in your home. It's important to state that you can move into your home even if your construction loan is still in the construction loan phase. We get people all the time that say, oh gosh, I'm going to pull my last draw. I'm going to get my final inspection tomorrow. Do I have to wait until my loan is converted to a mortgage to move in? And the answer is no. Once you have your CO and it's legal for you to occupy the property, you can move in. We may be in the process of working on your conversion to your mortgage, but go ahead and move in once you have your certificate of occupancy. The other piece that's really, really important right here is to note that the house has to be completely finished according to the appraisal in order for us to do the final mortgage documents. Here's a good example. Somebody may say, well, the house is done, but I'm still working on the garage. Garage doesn't have a garage door, doesn't have electricity hooked up, or there's no shingles on the roof. I have one right now. They're in an area where there's high wind in the wintertime, and they can't put the shingles on until spring on the garage. That loan, that permanent mortgage, is typically a Fannie Mae or Freddie Mac loan. Their guidelines say that the house has to be completed. So we can't complete that mortgage until all of the home is completed. There might be a few little things and we can discuss those things, like a couple pieces of trim aren't up yet, or maybe there's a door missing on one of the cabinets in the kitchen that got back ordered, or things like that happen all the time. And we can let you know if that's going to keep you from getting your final mortgage. But typically the house has to be completed, fully completed, and you have to have your certificate of occupancy. And then that's it. You move into your home and live happily ever after.
Wow. Thank
How's
you,
that?
Jeff.
Yeah,
That was really helpful. Really appreciate that. That I learned a lot. That was really, really, really good. I know I'm going to be going back over this recording again because that
sure.
was just lots of info, lots of value. We have a couple of questions here. I'll just read it out loud.
Sure.
When moving into a mortgage, is there another loan that has to be completed associated with the closing costs?
So our closing costs are kind of split between the two. Most of the closing costs occur in the construction finance side. There's very little cost when we do the conversion. We can charge it all up front in one cost. There's a thing called a one-time close loan where they do everything up front. There's a two-time close where you have two sets of closing costs. It's essentially this, the closing costs are what the closing costs are. And actually, we try to put the bulk of that on the front end on the construction loan. There's very little at the conversion. There are no bank fees when we do the conversion. We have to update the title, and we may have to get the appraisal recertified for value, which happens whether it's a one-time or a two-time close. So closing costs are going to be about the same whether you would do a one-time close or a two-time close. They're pretty much the same. There's very little difference.
Got it. Thank you. And then another question, specifically for veterans. Does FSB manage VA type construction loans, or is that another process? How does that work?
Sure. I forgot to mention that the Federal Savings Bank is a veteran-owned bank. It's privately held by 5 veterans. We were one of the top VA lenders in the country last year. We do a lot of VA lending. And so the answer is yes. We're very, very familiar with VA construction and VA financing. So we follow the VA guidelines on VA loans.
Oh, wow, that's really great. And what kind of procedure or differences are there with VA loans?
VA loans, well, it can allow a higher loan to value, less money down.
Okay.
One thing on a VA loan, our VA construction loan does not allow for financing the closing costs. The construction costs are one thing, the closing costs are another. So you have to have a certain amount of cash to do the VA closing costs on a VA loan, but it requires less money down. We can actually do FHA construction loans, which can allow for as little as 3.5% down on the construction costs. And then we do loans all the way up to 95% on conventional loan products.
Got it. Got it. Thank you. And then another question that Tony has that I was actually curious about too is there a different interest rate for the interim construction loan versus the mortgage loan? How does that rate work?
Right. So our construction loan rates are fixed for the period of the construction. Then when we go to do the conversion, we're going to take a look at that loan. There's 2 ways you can work on the rate on the end loan. When we do a construction project, we do have a long-term lock program. We can lock the interest rate in on that conversion, that end loan, for up to 12 months in the future. That's all the industry offers, is a 12-month period of time.
Okay.
Otherwise, we're going to kind of keep an eye on that interest rate while you're doing your construction, which is how I prefer to do it right now, because we're actually in an environment where interest rates have started coming back down again. Can't guarantee that, but they have been getting a little better. So we can watch that when you're in your construction period. If it looks like rates are going to dip back up or go back up for some reason, we can always come in and do that advanced lock program.
Got it.
Your end loan rate is going to be a different rate depending on whatever current market rates are. If you do a long-term lock, you do have a feature with that where that last 30 days before the loan converts, if rates go down, you can lower the rate. You get what's called a one-time float down, where you can float the rate down to the current rates. It has to be within 30 days of you converting the loan to a mortgage. So it's a nice option to have.
Got it. Got it. And Tony also asked another question. Do you offer USDA 1XC? I'm not familiar with this.
One USDA one-time close. We do not have that product right now.
Okay.
We do not do that.
Okay. And Quinn asking about the average starting cost of the small square foot for a home. So I'll take that. Quinn, when we're looking at square footage cost per home and we're talking specifically construction costs, the smaller the home, sometimes the higher per square foot cost there is, just because the economies of scale are different and all the efficiencies are different. If you're looking at a home that's under 1,000 square feet, we have a few mini homes that are about 700 square feet. You're going to be typically higher, like 320, 350, depending if you're choosing an essential line, which is like an introductory line, smaller windows, middle of the road appliances. If you choose the advanced line, bigger windows, upgraded appliances, the prices are higher. Typically, when you're choosing a home that's around 2,000 square feet, we can get costs to about $280 a square foot. So the actual cost of the home is going to vary. The best thing you can do is just email us, hello@dvele.com, and me and Ashley will answer your questions there, specific to your project, the type of home you're looking for, all that. Let me just see if there are any other questions. Quinn asking about how do I know if we build in your area? Well, we build all of our homes out of our one factory, Quinn, in Loma Linda, California, which is Riverside, California, just outside of LA, and then we deliver to mainly the Western United States right now. We can deliver to further states, but the cost of delivery gets a lot higher and it outweighs the cost of choosing a factory built home. So yes, we can technically build in your area, but we build the same home using the same materials for all of our homes, metal steel framing, high efficiency, but it really depends on where you're going. And if you're on the East Coast, unfortunately, right now we can't deliver there. It's just too high of a cost, and we don't know any general contractors in your area yet that we've vetted. But as we add new factories are going to be coming online about every 2 years now. We'll slowly be able to creep further east. Sounds good. If there aren't any other major questions, do you think there's anything else you want to add, Jeff? Or
well, I just want to make one comment on that last question. So if somebody's trying to build a home on the East Coast, even though Dvele may not serve that area, we do loans in all 50 states, and we have
great
top-notch home builders pretty much everywhere where we go. And as long as Dvele is okay and says, hey, look, this is somebody that wants to build in the East Coast, we just can't service them right now, we can still help you with the financing, and we can even help you locate a good home builder if you need to do that. You can always reach out.
Sorry, I'm just answering some chats here. Okay. Tony's asking, what is the
other questions from Tony there?
Yeah, max draw allowed to start construction, specifically sent to the factory. Is there a max draw amount? So like if, we have a $700,000 home, are we asking, we're not asking for the full amount up front, but right. Typically is there a max up front?
So go back to the term progress payments that I used early in my presentation. So the way the contracts are typically drawn up, whether it's Dvele or any other system built manufacturer, they're going to put in there a draw schedule that's going to say something like some manufacturers want 20 or 30% up front. Some ask for 10% to get the project started, another 40% when the house goes online, and the rest of the money when the home's completed. Your second question there, Tony, about can we pay for the house when it leaves the factory? The answer is yes. There are a lot of lenders who will not do that, but we understand that process and we will do that. We just have to make sure that there's certain safeguards in place, things like certain types of insurance, to make sure that if anything happens to that house, that it's completely covered. But we do it all the time. We do the draw once the house is completed at the factory. We'll finish up that portion of financing.
That's okay, Tony. Yeah, working with different video platforms can have some technical issues sometimes.
Sure.
Quinn's talking about his build is about 2 years out. So yeah, we might be able to help you in 2 years, Quinn, hopefully. Another question, what about, Jess is asking, what about problems with the transportation of the home components during the delivery process? Who is responsible for fixing any issues? I'll take that, Jess. Really, we haven't had any issues during the transportation. Early on in the process, we vet your property. You give us your address. We look at the route and several routes to your home. If it's feasible to deliver a module home, because we're typically looking for enough space that will span about 18 feet wide, 18 feet high. And depending on the modules that come in your home, they can be up to about 60 feet long. And it's on one solid flatbed. It's not articulated. So up front, we make sure the module can get to your house. It's safe. There are no branches, trees, low-hanging wires. And then your land is also buildable. So if we can get to your property, then we really have never had any issues delivering it en route. If something does happen during the delivery, some sort of process, issue with the manufacturing or just, some sort of storm or something falls on it, we would be responsible for fixing it, because technically it's still in our care and we haven't handed over the full keys to you. So we'd be taking care of that. Tony, to contact me further, me and Ashley, we are taking care of all the sales and the conversations with people like you. So if you email us hello@dvele.com, it'll go to both of our inboxes. So myself or Ashley, who's been on the team for about 4 years, really knowledgeable, will be able to help you and get back to you about anything else to do with your property and your project.
Kellen, is it okay if I put in the chat my contact in case they
want? Yeah, absolutely. Please. Anything lending questions related? Yes, you'd want to speak to Jeff. So Jeff's going to add his email to the chat. He's going to be the guy to speak to about this.
There we go.
Thanks, Jeff. Wealth of knowledge.
It comes with doing it more than once.
Yeah, which is, I think, what you want. People want peace of mind when they're financing these types of projects and doing these types of homes.
Right.
So I really appreciate your expertise, really appreciate your time. If anyone's watching, don't worry, we've recorded this. So we'll be sending out a recording as soon as it's finished downloading. If you want to get in contact with Jeff about financing questions, his info is there at the bottom of the chat. If you can't read it, it's Jeff Crowley at thefederalsavingsbank.com. Sorry, it's Jay Crowley, and it is Crowley, Jay Crowley at thefederalsavingsbank.com. And his phone number is 970-297-7219. So in our follow-up email with the recording, I'll make sure to send out the landing page that we have with the Federal Savings Bank to fill out some basic info that Jeff asks for when doing these types of projects. And I'll also include his contact info in the email if anyone has any more lending questions. Jeff's really quick to respond, really responsive by the phone as well. He's been an amazing asset for me as I've learned about these financing projects. So please don't hesitate to contact him. Thank you again, Jeff. Really appreciate your time. We're coming up to about 55 minutes here, so I won't take up more of your time.
You're very welcome. Thank you for having me on today. Thank you.
Yeah, you're welcome. Take care, everyone. We'll talk